I can't agree to this.
But, Miss Tan, it is your father's wish. Both of you will have an equal share to the house.
No. Hey, that's mine. Give it to me.
Me first. That's Jaz's philosophy in life.
Late already. Everyone should sleep.
Jaz! She doesn't care what everyone thinks, even when Pa was around.
Let me see what else.
Pa! You're ordering food from the app again? It's just down the road. Anthony, quick help Kong buy.
She doesn't care what her friends think.
I didn't have the wine, so I'll just pay you my share of 52.50.
All she cares about is money, even when it's not hers.
Come, Auntie keep your ang pao for you.
Sunroof, nice. She doesn't care how I feel. Hey, Jay, come check out my new car. I traded in the previous car before it loses its value.
Your car was working fine. You're already so stretched. Where's money?
Wow, you two make this for me?
Hello, everybody. I bought a new TV. She only cares how she feels.
Hey, isn't it the same size?
This is 4K, and I bought it with 0% installment. Every month, only a few $100s.
You're so impractical. Our house already got so many things.
If you don't want so many things, you go back to your own house lah.
Excuse me. At least I have my own place and getting rent.
We can always use it in our
If I'm
bedroom.
not here...
Enough!
I thought Pa's death would change her. When do I have to settle this?
As soon as you can.
No. I want to give my share of the house to Derek.
Pa's death didn't change her. It changed my perception of her. When I lost my job, Jaz supported my family. She even paid for my boys' overseas education.
Auntie, thank you.
I didn't do much lah. You saved it yourself from all your ang paos. Study hard. I'll be okay. I have my retirement all sorted out. In fact, I'm much more worried about you.
By thinking of herself first, she thought of everyone else. Jaz's philosophy in life: me first.
Good evening, everyone, and thank you for joining us today on how to strengthen your retirement planning through a Me First approach. I'm your host for this evening, Otelli. Now, today we're going to be discussing what putting yourself first actually means and how it can help you identify your priority goals and enable you to plan earlier and better for your retirement. And we also have in store some useful tips and strategies you can take away for successful retirement, no matter which stage of life you're at. Now, just before we get started, just allow me to introduce a couple of Zoom functions that you may be using within the next hour. So if you look at the bottom of your screen, you're going to see the chat and Q&A buttons. If you would like to share your thoughts, or if you're experiencing technical issues, you can type it in the chat window. And as we'll be taking questions during our webinar, you can also send them along at any point using the Q&A function. And lastly, we also like to encourage you to take part in our polls by simply clicking your answer when a window pops up on your screen. Okay, without further ado, let me introduce our three speakers who are joining me today virtually. They are Jun Sen, correspondent with Today Online. We've got Timothy Ho, co-founder and managing editor, DollarsandSense.sg. And Yong Chuan, premier financial consultant with Income. Well, pleasure to have the three of you here today to share your perspectives and personal stories on your retirement planning journey. But just before we kick off, let's just take a quick poll to better know all of you who are joining us. It's going to come up on your screen. Basically, which age band do you fall under? So we would appreciate it if you just take a few seconds to just click your answer, and it will just help us, better fine-tune our questions and know who is watching this webinar. There we go. The bulk of you between the ages of 50 and 59. Also, we've got quite a fair bit of millennials tuning in. So, okay, thanks for, answering that poll. So basically, we're here to discuss how, to strengthen your retirement planning through a Me First approach. And first up, let's just talk about what Me First even represents and why it is important. Now, this is basically built on the insight that we live in Singapore, right? And we live in a society that's largely shaped by Asian values and a collectivist culture, being taught to put others before ourselves, as you would have seen, in the video just now. And we tend to be excessively generous with others, but we often act on the opinions and expectations of others rather than what's actually best for us sometimes. However, when we constantly desire to please or impress those around us and prioritize the needs of others before ours, we actually tend to think less about our personal needs, and such actions can sometimes come at a personal expense, such as failing to keep our personal finances on track. In fact, Income conducted a survey with 500 Singaporeans aged between 21 and 68 years old to understand their sentiments towards this notion of Me First. And the survey revealed that actually 98% do in fact agree that there are times in life when they will have to put themselves first. And this also extends to different areas of their lives, especially so when it comes to their health. So basically, as you can see there, they are ready to put themselves first when it comes to financial matters because they believe that small actions over the years add up to have a big impact on our future finances, and such actions will benefit their financial standing in the long run. So it's behavior that reflects financial responsibility. And culminating in 93% of Singaporeans believing that putting their financial needs first enables them to start planning earlier and better for their retirement. All right, so without further ado, let's hear from our panelists. Let's perhaps start with you, Tim. Your thoughts about these findings and the overall concept of Me First.
It's like being a lifeguard, right? You can't save somebody who is drowning unless you yourself can save yourself. So you can't save others if you cannot take care of yourself first. For me personally, I see that in my life. So I'm quite fortunate in the sense that, I'm currently in the stage in life where I have elderly parents and I have 2 kids as well, so 2 young girls. And I'm in the stage of life where some people call the sandwich generation, which means that, I have my 2 young girls that I have to take care of them, but I also have elderly parents that I have to care for. And one thing that is, I think, I really see the Me First illustration being valuable here is that my parents, when they were younger, they actually make effort to actually plan for their own retirement, their own financial plans. And this is now a huge advantage for me because now that I'm at an age where I'm working and I have my own kids, I can actually, I don't have to actually worry for them financially. I can just focus on my own personal finance, take care of my girls, take care of my family finances. And my parents, because they're healthy, are still in a position where they can also help me. So because they help themselves, they take care of their own finances, now they're also able to help me, in other ways, bring the girls to school and things like that. So I absolutely think, a Me First concept makes a lot of sense when it comes to retirement planning.
And Jinsen, are you also part of that sandwich generation?
I don't have children yet, so I never had the experience that Timothy had to spend and think about the people on both ends of the spectrum. But his sharing really resonated with me because the idea of Me First is truly an interesting one. It goes against the grain of what most of us are brought up to think. We tend to think that in our culture, our parents would go out of their way to give us the very best. They pay for the meals while giving us the biggest slice of meat. They are willing to invest in our education. They're willing to do all these sacrifice for us if need be. And eventually, when they reach their old age, it falls on the children who have had higher earning power, more education opportunities, more global opportunities to make money in their lifetimes, to support their parents financially. But the reality is, how is this notion of filial piety going to change going forward? And it's a topic that's set for an interesting discussion. Many of the articles that today have written about on this topic of filial piety have received much attention. For one, our family sizes are becoming smaller. It used to be the case that among the many reasons for having children, one of the most compelling financial factors is to have someone to look after you in your old age. But today there's the sentiment that it is too expensive to raise a child, so younger families are having fewer kids, which would also mean fewer children to support their aging parents in future, and their burden that Tim just spoke about grows heavier. So past surveys actually have shown us how elderly get by the retirement years. And it tells us that income transfer from children is actually diminishing as the most important source of financial support for the elderly. And this decline is actually happening very fast. Which is why coming back to this Me First concept, it's really an interesting way to reflect these changing circumstances. It means looking after yourself first and having that financial independence in your retirement years. And it means when you become older, I want to be able to stand on my own feet and not be a burden to my children. I believe this sort of concept is really growing in popularity amongst the younger generation.
Yong, Chuan, your concept of Me First.
I think thank you, Otelli, fellow panelists and audience for setting aside precious time in joining today's seminar. I think today's discussion is about a very important topic in our generations, which is often being underestimated, and that's retirement planning. I think a key message for today is the best plan for our retirement is to start with Me First. I think for many reasons in our life, we tend to misjudge the importance of savings when we were younger, and we tend to look back with quotes like, "What if I have done this when I was at a certain age?" or "I wish that I could have done more when I was younger." Like what Ginseng has earlier shared with us on the growing desire for financial independence and to rely less on children during our retirement years, Income has also been trying to encourage people to do this through our Best Gift and our last generation, salary generation campaigns. Through such initiative, I'm glad to see that a lot of more people are becoming more aware about the needs to be financially independent and to take actions to plan for their retirement.
And speaking of retirement, I'm just curious to know how many of you in the audience have already started planning for your retirement and if you're on track to meeting your goals. So we're going to take another quick poll here. Again, just click on one of the options in the pop-up screen. And the question is basically, have you started planning for your retirement? We are going to tabulate the results and you will see where you are at. Once again, just a reminder, if you've got any Q&A for our panel of experts, you can just pop them in the Q&A section at the bottom of your screen. Okay, well, we are waiting for that results. I mean, clearly, I think we have to bear in mind that our retirement goals change over time, and personally, I'm taking this opportunity to learn from our panel as well, because it's never too late to start. So I am one of those who's just sort of starting. Okay, so we have our poll results. Okay, most of you, 55% of you say, yes, I have started planning for my retirement, but I need to do more to meet my goals, +1, so myself included. And retirement planning is such a huge topic in Singapore, especially we're facing an aging population. Ginseng, I believe you previously wrote a piece on retirement adequacy in Singapore. You've done extensive research on the retirement landscape here. Can you just share with us what are some of the key takeaways?
are indeed many factors that come into play when that actually does affect one's retirement planning. I mean, chief of most is the fact that we're in the middle of a pandemic here. You know, we're talking about tough economic conditions, we're talking about job insecurities, and we are in the middle of a long-term low interest rate environment, which actually translates into house savings and investments being affected. And there's also the vagaries of passive income like rent, the real estate market, and the growing need underscored by this pandemic for an emergency fund for future crisis. We're talking about disease X or even climate change, you know, something that would actually require us to break open the piggy bank and pour it into some emergency need. And indeed, from what I've seen, many Singaporeans, including many of my peers who I often talk to about retirement, are actually financially unprepared. And not to mention there are so many present day obligations, which I'm sure many of us can actually relate to. Raising our kids, having to look after our aging parents, and the mounting healthcare bills that will actually result. And the credit cards, the mortgages, the utility bills that need to be paid, considering the unprecedented shock in energy prices that we've been seeing lately. And all the while, amidst all this, we're trying to fulfill our personal lifestyle goals as well. You know, dining in nice restaurants, taking a vacation twice a year as soon as the pandemic restrictions allow for it. And all of these will actually set us back in our retirement planning. But that said, I think it is not that Singaporeans don't know how to save for a rainy day. Most of us actually do know how to save. The problem is most of us don't know how to grow their money or invest. Perhaps this risk aversion during a pandemic like this.
And Young Chuan, I mean, is it true that you think most of us just don't know how to grow our money?
Certainly, I think it's true that many of us are trying to save as much as we can, but sometimes without the right strategy in place, I think a large portion of our cash savings can often end up sitting inside the bank account, which will not be able to even beat the rate of inflation, as well as the rising cost of living in the long run. I think Ginseng recently also wrote an article in today's news article that inflation is going to be expected to pick up in the year 2022 as the global economy recovers from this pandemic and the living costs are set to increase as well. So my advice is very simple. Don't be afraid to ask for recommendations and be open-minded about the various retirement strategies or even instruments out in the market that can help us to further grow our wealth. And definitely with the right strategy, we can get to enjoy life during retirements.
And also don't forget, our audience to ask questions. If you've got any burning questions for, our panel, we'll get to it in a bit. We've got Q&A session, towards the end of it. So do pop your questions in there. So, well, let's just start with a question that I have, which is also not an uncommon one because it's often asked. Just how much is enough for my retirement? I mean, is there even a magic number for, example? Because I think that defining your goals is a good area to apply a Me First approach because there clearly isn't a one-size-fits-all goal and strategy. Tim, your thoughts?
Good question. I think there are quite a few popular trends that I'm seeing right now. So one of the popular trends in Singapore is 1M65. Which is to get $1 million by age 65 in your CPF account, and other trends will be include FIRE, which is financial independence, retire early. So these are some popular trends that a lot of people sometimes hop onto these trends. I think for a good reason. I think it's always good when people take retirement planning seriously. But I think there is the caution here that a plan that works for someone else may not necessarily work for you. So for example, for myself, I don't really want to retire early because I like what I'm doing and I'm still working towards it. So there is no need for me, or there is no need for you to follow what other people have said. I think the other point worth noting is that even your own personal goals and your strategies may change as you grow older. So for example, if you are younger in your 20s and you don't have your home mortgage yet, or you don't have kids, then topping up your CPF, topping up your Medisave, these might be good strategies to get started on retirement planning. But when you're in your 30s, you're in your 40s, and you have more commitments, you have more liabilities like your home mortgage, such a strategy may not make a lot of sense anymore. So you might want to look at other areas as well. For example, investing in stocks on your own, or even considering retirement planning products, because these are other strategies that you should also consider.
And Yong Chuan, having all these goals, big ones, little ones, it's all very challenging. So how do you, even advise your clients how their, what their retirement needs are and how they should go about planning for their retirement?
Okay, how much is enough for retirement? This is one of the most common questions I receive from my clients when it comes to retirement planning. Indeed, retirement planning varies from person to person, and having a huge goal at the start can be really challenging, especially when the goal is for retirement. So there can be a massive temptation for us to actually procrastinate, and which can eventually defeat the purpose of having a plan. So the last thing that we want to be is to be unmotivated and not to start a plan altogether. So having a tailored retirement goal for each individual plans would usually depends on various factors such as income, time horizon, risk appetite, and the desired type of lifestyles that we want, both current and for the future. So before we even try to search for the magical number, we need to ask ourselves, what exactly does retirement means to us? For this question, we need to be very truthful to ourselves because this will actually set the stage ahead. So I like to actually share this a lot. Okay, retirement is not the end objective. The true spirit of retirement is really about trying to start a brand new chapter of our life during our golden years in as meaningful way as possible to enjoy. And we can only achieve this by trying to align our lifestyle and our financial resources. So at the end of the day, it's not any specific figures that we are trying to achieve, but more of what it takes to feel happy and secure. Therefore, having a retirement nest will actually give us the assurance that we need not to worry about our money when the times come, especially when we eventually have to stop working.
And speaking of having stopped working, but before that, for our millennials and also a lot of people who are going through mid-career choices, people are just chopping and changing their career choices as they move along, as they evolve. What makes them happy? So Junsen, you think the retirement plans also need to change along with your career choices?
What Yong Chuan just said about how it really changes from person to person. And I want to draw attention to a group of workers who have faced so much change in their careers in the last just the last 4 or 5 years. And a few months ago, I interviewed a group of food delivery workers who are operating out from platforms and gig work, who are all around my age. And the reason why I went to them is because the pandemic has made their job such a popular and lucrative one. I asked them about their financial security, and they replied that actually that financial security has never been better. It is actually possible to earn $3,000, or if they work hard, $5,000 a month. And one even told me this job is crisis proof. People need to eat after all. And working as a gig worker, it's a lifestyle choice for many people who are very happy with the flexibility of work that such work provides. But the question is, what about retirement? Because as self-employed workers, they do not have the sort of employer and employee contributions to CPF as salaried workers do. Are they investing actively and getting a passive income? Perhaps, but maybe they are also squirreling money away for a rainy day. But can their savings actually last them until they hit their retirement age? The reality is that food delivery riders are in the headlines because they are such a large visible group of workers, but it also affects other millennials who I know aren't contributing to CPF. I'm talking about new entrepreneurs who are putting everything on their line to make their business dream a reality. They do not pay CPF because they are technically self-employed. Real estate agents and even caregivers who are often women who aren't working due to family commitments, especially needed their services, especially needed and skyrocketed during this pandemic. And this lack of CPF contributions actually have a huge bearing on how they save for the future. This group in particular actually needs to take a holistic view of creating more income streams and evaluating how they can maximize their money further. They need to be mindful of plugging these gaps typically enjoyed by other company employees, such as having medical benefits, where these people do not have enjoy any of such benefits because they are not they're not working on a contract or on or covered by the Employment Act.
And as you're talking about entrepreneurs, I mean, Tim, you're Exhibit A, you're an entrepreneur yourself. I imagine quite a bit of concern because when you first start out, the financial instability, that must have been a big worry.
Yeah, I think what Chuan says is absolutely true. So for me, I was actually working about 3 years before I went to join and start Dollars and Cents and work on it full time. So when I went to Dollars and Cents, I actually make it a point to continue contributing to my CPF accounts, right? Because to me, it was very important that financial stability is one of the areas I don't compromise on, even though I am going into entrepreneurship. I think one of the mistakes that a lot of young entrepreneurs do make today is that, I mean, entrepreneurship by itself is quite difficult already, right? Making money for your business is not easy at the start. So it's very common that contributing to their own CPF account could be the last thing that they're thinking about. If cash flow is tight, why contribute more to your own CPF account? But I think that's a mistake, because the fact is that CPF contribution, especially when you're young, it actually compounds a lot when you're in your older age, when you're going into retirement. So one of the things I did was I continued to contribute to my CPF account. It also helped the fact that, by then when I was doing Dollars and Cents full time, I already had a home mortgage. So I had to service my home loan using my CPF OA. Another thing that I think a lot of entrepreneurs or self-employed people don't realize is insurance coverage. Because when you are an entrepreneur, essentially you are the person that if you fall sick, if you can't work for a few weeks, a few months, then your family don't have money, right? And so insurance coverage is even more important. The irony here is that when you work with a company, you have group insurance coverage and things like that. And actually you, in some sense, you need your own personal insurance, but you don't need as much because your group insurance coverage do cover you a fair bit, a little bit, right? But when you're an entrepreneur, when you're a self-employed person, you actually need more insurance coverage. But what I typically observe around me are that, the entrepreneurs, the self-employed people, maybe because they don't have a stable paycheck, this is actually an area that they neglect. And I think it's very, very dangerous, because all you need is for a unfortunate accident or incident, and you basically lose your livelihood to make a living for yourself and your family. And there's no company, you're not working for someone. So I think that's something that Chun saying is absolutely right. We have to look at these things more carefully.
And not to mention that our life expectancies are increasing. People in Singapore on average live till 84 years old. So ginseng, and things are getting more and more expensive as well.
According to our projected futures, to tailor a plan that's just suited for us. Because with increasing life expectancies, all of us will be living longer lives on average, and that means retirement costs will actually skyrocket, will go up and become more expensive. At the same time, most of us are also having smaller families, which means fewer children to support us during our retirement. People are also getting married, having children later, or even opting to stay single. For singles, for married couples without kids, one may think it would be easier for them to plan for retirement because after all, they're not spending so much on their children. But the reality is that they also have the challenge of needing to be fully financially independent. They cannot count on the later generation to top up what they are not able to provide in their later years. And should anything unfortunate happen when they become older, they will have less of a financial support system than families with children or even those with a stronger support system. So at the same time, many of them fall into the trap of living it up when their income increases. The more we earn, suddenly the more we want to enjoy our little luxuries that we have to balance. And when we have to balance with the need to save, this going to a restaurant and basically living it up. Beyond that, society values have also evolved, and many millennials these days are also choosing to move out of their family homes before they hit the age of 30, which is certainly having an impact on their financial planning. And at the same time, it's interesting to note that for many youth today, they actually define early retirement as a moniker, as a benchmark for success. But their current lifestyles actually do not match these aspirations for the future at all, because they're spending beyond their means and all that. So, generally speaking, I think I want to ham this message that many of us want to continue living with purpose and dignity and keeping our lifestyle constant as it was when we were earning an income. Because when we hit our retirement years, and if we have set our hearts on traveling during our retirement or enjoying other little luxuries, some things have got to give. Naturally, this actually means having to set aside more for such expenses.
And as we go through different phases in our lives, whether it's every 5 years or every decade, our goals change, maybe our career choices change. So, Tim, basically, how would someone typically go about even understanding their own needs and defining their goals?
I think the easiest way to start is just to be interested in the topic in the first place, right? So awareness, education, these are very important things. You got to read articles, nowadays, online content, you got sites like Dollars and Cents, Money Smart, Seedly, mainstream media today, a lot of finance content. And I think the first way is just to get started, read as much as you can. But of course, just reading and having head knowledge is not enough when it comes to finance, right? We have to put our interest, our knowledge into actions. And one of the easiest way you can do so is just to talk to someone who is a little bit more proficient in that area, right? So a financial advisor, a trusted financial advisor would be a very good start. Just to share an anecdote, even for myself, I think I'm quite financially savvy because I write about these things all the time. But even when I talk to my advisors, when I have my two girls, when both times when they come out, I talk to my advisor to review my insurance coverage because I wanted to increase both my term life or as well as my early critical illness plans. I actually talk to them, and one thing I realized is that based on my existing coverage, I can actually increase my coverage and still pay a lower premium. So I can actually, save money while increasing my coverage. And these are the things that obviously you wouldn't know unless you talk to your financial advisor. And when you talk to them regularly or in at least key milestones during your time, you get to learn a little bit more. And I think that's one of the ways we can, actually get started or at least, continue to improve even on our existing financial plans.
So, of course, I have to bring you in, Yong Chuan, being a sort of financial expert. Being financially savvy, it is important, but it's easier said than done. So what's your advice, to people who are trying to find an advisor to help them out manage their retirement plan?
I think thank you, Timothy, for actually trying to emphasize the need to actually seek professional help in topics that you are not familiar with, or even if you are familiar with, I think it's good to actually be open-minded and expand more ideas on it. So yes, being financial savvy is very important. And actually right now, there's many types of resources and contents online that can actually provide us with a rough indication of what is needed for retirement. But we will still strongly recommend to have a chat with a professional so that they can actually help us to access and quantify our needs with the aim of trying to develop a holistic personal financial plan. So this is always going to be a very dynamic process. So because our needs, our goals changes over our lifetime. So it's always beneficial to have someone to help us to actually review our plans along the way to ensure that we are always on the right track to meet our goals.
And Jinsen, perhaps you would like to share with us, I'm sure you've got an advisor, financial advisor as well. What were some of the key takeaways you had based on your, discussions with your advisor?
Well, each time I meet with my financial advisor, he will definitely stress the need to make your money and your assets work for you. And the real key here is to try to beat inflation rates. And I think this is something that Yong Chuan picked up on earlier, that actually the recently inflation, which is the price of the consumer price of products, is said to actually go up post-pandemic due to complex economic forces, something that we could spend another hour just talking about. But potentially, the inflation rates that arise from any pandemic forces potentially could result in a generational change from the low inflation that we've been so used to in the past 10 years or so. What this means actually is that we have to be more active in our investment strategy because the goalposts on inflation have moved. It's not just our needs and goals changing over our lifetime, but the goalposts on how much we actually need for retirement is just going to move forward. Your kopi is going to cost more. So at the end of the day, someone who can help you assess your risk in this fast-moving world, who can tailor your whole spectrum of investment products out there, and to look out for the blind spots. It's really a good idea. Speak to someone professional, so you don't end up putting all your eggs in the same basket. Because at the end of the day, diversification and having the right mix of assets can help you maximize the sort of risk reward that you get from your investments.
Now, gentlemen, we are actually getting questions from our audience. We've got a question here from Jackie, and I would just like to direct this to Tim. Jackie's question is, we need funds for emergencies, at least 6 months' salary. Is this still applicable? And do I need to fulfill this before starting to save or invest for retirement?
Great question. I think yes. So I think 6 months of salary is one rule of thumb. For me, I like to think of it as about 12 months of monthly average expenses. So for example, if my family expenses on average is about $4,000 a month, then I want to have about $48,000 to $50,000 as emergency saving. And the reason for expenses is because, it's not so much of your salary that matters, but actually how much you spend, right? So the more you spend, the more of the emergency saving you need, right? So if you earn 5,000 but you're spending 6,000, then firstly that's not good. But then that also means you need a higher emergency saving. And I actually think that it's quite important to have that emergency savings first before you think about investing more into things like stocks. I mean, you can actually invest a little bit. So for example, nowadays with robo advisors, you can invest from as little as $100 a month. So even if you haven't gotten your emergency saving, I think you can still invest a little bit. But I think if you want to make a concrete effort to invest more, you first want to make sure you got your emergency saving. I think secondly, you want to make sure you got your insurance coverage right as well, right? Because your investment investment is like getting your upside, but insurance coverage is the second thing you should also consider. And once you have those two set up, then I think you can make a concerted effort to invest more aggressively. You can afford to take a little bit more risk because you have your emergency and your insurance coverage handled already.
Okay, so moving along now, let's just talk about strategy. How can we apply the Me First approach into actionable steps that we can take? Yong, Chuan, perhaps you want to kick things off with that, with your advice.
Sure. So at the start of this webinar, we have actually touched on the importance of having the right mindset towards financial planning. This is critical, but what truly determines the outcome will be the actions that we take today. So the first and most important steps, I would say strategy, is to take immediate actions and to start as soon as possible, especially if you are young. We can start off by asking ourselves this question: do we actually spend first and save the balance, or do we save first and use the balance? Once you can understand the meaning to this question, I believe you'll be more prudent with your spending and start to find ways to save and grow your wealth. So first and foremost, the simplest way to start is to pay yourself first. Some of us would call it a reverse budgeting strategy, where we build our savings and spending plans around our saving goals. Make this simple shift in mindset can have a huge impact on keeping our saving goals on track, but not at the expense of necessary expenses like our housings, utility bills, and even insurance.
An interesting way to look at things. A lot of millennials always have that mindset of the YOLO mentality, right? You just pretty much spend what you earn. Therefore, a mindset change is definitely what we need. But aside from that, what else should we be mindful of? Yong Chuan?
I think to drive in towards this strategy, right, I typically suggest this split with my clients. For example, having a living expenses and essential cap at 50% of our income, 30% for funding financial goals like insurance, savings, and investment, and finally, 20% for flexible spending on our wants, such as shoppings, travels. So we are not trying to say that you can't enjoy nice things at all, but it's important to set aside our savings first. So this concept is even more important for those with multiple dependents, as there's always something that we need to pay for, which we can't often leave us with nothing else to save or invest. So with this, right, I'm sure right now you're looking at a triangle over here. Okay, I'm going to share one of the key framework that I usually use with many of my clients. So the more we want for retirement, the higher up the triangle we want to achieve. So looking at this, everything starts with a foundation, and that's risk management. So before we even start to build the big house that we wanted, we first of all must need to ensure that we have to secure our door, our windows tight, make sure there's no leakage. So from a practitioner point of view, when it comes to retirement planning, there can be blind spot where people often focus only on wealth accumulation. But we do need to look at this in a more holistic way by prioritizing protection and our long-term care needs. So this will actually allow us to prepare and protect our wealth against unforeseen incidents that might affect what we have worked so hard for. Therefore, being protected against this risk, right? For example, untimely death, major illnesses, or even large medical expenses, and even long-term mobility issues. These are things that we will encounter as we age, and essentially, we are trying to transfer this risk to the insurer. And the earlier we do this, the better it is. So I have actually come across quite a few customers who have done the extreme of only planning to save hard for their retirements, but forgetting to actually close their protection gap. So when things happen, for example, illness strikes, this actually took a huge hit on their retirement nest. And I'm sure that nobody here wants to save hard for our retirement, but eventually have to use this to pay for medical bills.
And Tim, let's just, perhaps you can just tell us if you have, what kind of protection gap you have.
I think based on my experience, and I think that applies for most people, these protection gaps tend to surface during certain key milestones in our life, right? So the first one will be when we start working, when we get married, when we have a property, when we start having kids, and then maybe even like if like me, you start a business, right? So these milestones in life, of course, each of these milestones are great milestones. So we celebrate, when we get our job, we celebrate when we get a house, we celebrate when we have kids, right? But I think one of the things we can't forget is that there would be some form of protection gap, because usually with all these milestones, we start to have a bit more liability, a bit more responsibility to take care of people. And I think, it's very important to review our coverage particularly during these milestones in life.
And Jun-Sen, in terms of your risk appetite, how would you rate that? How would you say high or low?
I'm at the stage of life where several big ticket items are on the horizon. It's buying a home, it's a wedding that's going to come. And then all these are affecting my risk appetite right now. But I'm hearing the advice, the sagely advice that my fellow panelists have been giving, to think early, to start putting money here and there, and what Yong Chuan stressed about, starting early, because all these actually compounds to something much bigger. And that's all very timely stuff that I'm jotting down, because that's things that will actually kick in later in life, and you might not realize. I thought it was interesting that many people in this webinar are of an age group much older than I am, and I have much to learn about what's going to come, be it medical bills, be it needing to spend on education for your children. So actually just sitting down and planning it out with an advisor is really something that everyone needs to do from a younger age.
Now, Yong Chuan, just before we move on to wealth accumulation, which we'll get onto, I believe there's a question which from the audience which you would like to answer. Her question is, what's a good balance for insurance? As in, what percentage should go to health, life, annuities, etc.?
Okay, just now I actually shared it's good to have set aside at least 30% of our annual money income into insurance, protections, or even savings as a component. So first of all, I think there's various forms of insurance in the market, okay? But it actually has to depends very personally which one is the concerns of the individuals. But let's start off with the most important thing I would say is medical insurance, hospitalization plans, okay? That's the key components, I think, for us to even move on to any financial planning. Because at the end of the day, with the rising cost of medical expenses in Singapore, I think the least that we want is to actually save hard or even work hard and eventually have to actually pay for medical expenses, and it will deplete our savings in a way. So basically, I think we have to start from the foundation. And it's actually easier for us to actually take small steps along the way when we try to achieve our goals. So basically, we have to look for, first of all, hospital plan that's good enough. Okay. Secondly, I think the next thing that we are looking at will be for life insurance, and especially with recent, I think a pandemic, I think a critical illness plan might actually come handily in the current context. Okay. As such, I think after we address the basic foundations, right, then after that we can actually move on to savings and investment. I think I would be able to share more on this in the next coming slides.
Okay, so Yong Chuan, let's just move on to wealth accumulation and help us understand the different strategies out there.
Okay, so relating to the questions earlier, right? There's no specifics, I would say, a percentage that we can assign this one. But once we reach the wealth accumulation period, right, we can actually ensure that we have to set aside 6 to 12 months of our average living expenses for our emergency funds. I think Timothy have addressed this very well just now. Okay, once we have addressed this component, right, I think the next key objective during this wealth accumulation stage is all about growth, because it simply doesn't make sense for us to actually work so hard to park our money into the bank or even to go for short-term instruments that provide lower interest rate after addressing our emergency funds for liquidity. So I would like to share an example of retirement instruments that I can actually share for wealth accumulation. That will be for what we call an annuity. Unlike the past, where the structure of annuity plans is quite rigid and limited, today's annuity plan in the market provide us with the control and flexibility to customize a plan that suits us the best. So we can structure this annuity duration, for example, when we will get to receive the payout, and then for how long do we get to enjoy this payout. And we also get to customize the contribution amount. How much do we set aside on a monthly basis or annual basis in premium, and the duration that we are comfortable to set aside to meet our retirement goals that we have set for ourselves. So illustration, I just give a simple illustration. So today we decided that we want to start savings at the age of 30. And we continue to contribute to this annuity plan for just 10 years, up to the age of 40. We will then let this money grow using the concept of compounding interest, let's say for 20 years, up till age 60. So from age 60 onwards, we will then be able to receive our retirement income for example, 20 years until age 80. And this will also help us to complement our existing CPF life scheme.
And Junsen, how do you think CPF plays a role in terms of ensuring that we've got enough retirement funds?
That Yong Chuan also brought up CPF Life to complement the sort of investments and plans that people have already, because it is also a form of annuity as well. When we talk about retirement planning, our comprehensive social security savings scheme, which is the CPF, is the bedrock of retirement adequacy in Singapore, because CPF Life provides payouts from the eligibility age of 65 to the end of your life. And I think that's why many of the people in this webinar are 55 years old and that age as well. They're looking at their retirement sums and wondering if it's enough. But the reality is that with discipline, in your earlier years, as you are in your working, when you're drawing a salary, you have to be topping up your CPF retirement sum to allow you and your loved ones to be able to build up your special accounts and receive higher CPF payouts later in life. And seeing the quality of life that most people also aspire to achieve, I feel that it's also important to complement CPF Life with other streams of income in retirement. And I think it's hard not to talk about property as well, which is where 40% of most people's wealth are, the asset that most people have placed their wealth in. And it is a huge part of any conversation about retirement, especially because most of us live in public housing. And if you do, one common option is for people to monetize their flat to receive a stream of income in your retirement years through the lease buyback scheme, while continuing to live in the same flat that they are drawing that income from. Or for lower income families, you can tap on the silver housing bonus when you downsize to supplement your income. And there are also other options that may not fly very well with the FIRE crowd, the financial independence retire early crowd, which is to consider deferring your retirement to later years so that the extra years of working can be used to supplement your retirement savings. And we've just heard from Parliament how retirement ages and re-employment ages will be raised to 65 and 70 respectively by 2030. It comes back to what I was saying earlier about living with purpose and dignity. It's not to say that we should work till we drop, but to be able to have the choice to work when we're still active in our older years and can still draw a salary and to keep mentally active. And these are just some of the key social safety nets that our government has provided, and to use them to supplement our retirement planning.
That's right, and ensuring that our basic needs are taken care of. But what if I would say still like to enjoy the little luxuries in my retirement years? I don't aspire much. I just want to be able to go to a restaurant. I don't have to look at the price of whatever food I want to order. And I'm sure a lot of Singaporeans also aspire to do that. So Yong Chuan, in terms of investing, what are your thoughts on how should we go about doing that?
Well, to enjoy a little bit luxury in our life, I think we have to take some form of risk. So basically, investment is one of the considerations that we can take into. Basically, there are many different financial instruments in the market, and people usually look for higher interest rate for greater growth opportunities. Having said that, the solutions does not always lie in chasing high interest rate, but ensuring that our money is kept in a secure financial instruments for the interest to actually work and compound for us over time. So once again, it generally depends on our individual risk profile and our goals for retirements.
And Tim, is this something that you'd agree with Yong Chuan on?
Yeah, I absolutely agree. I think one of the misconceptions or the train of thought sometimes people have these days, especially over the last 2 years, I'm seeing it with the rise of NFTs and Bitcoins and all the get rich quick strategies. I think we got to remember that financial planning, retirement planning, it's pretty much a marathon, right? It's not a 2.4 kilometer run, and I think sprinting out of the gates and doing well for just a short period of time is not going to be enough. What you want to do is that you want to be consistent in your pace, right? So one of the best things we can do, especially for those of us who are still young, is to really start young, start small. We don't have to invest a huge amount at the start, but to make it a habit, right? It's pretty much like your health, right? People get healthy. You get healthy when you're in your older age because of what you have done when you're young, right? It's not because it's when you are young and you live a healthy lifestyle. That's where you take it with you when you're older. You're still healthy, and I think the same logic applies to retirement planning. I think we need to start young, and I think we need to be consistent, make it a habit.
Right. Now, Yong Chuan, I can't help but notice actually at the tip of your triangle there, you had something that said wealth preservation. Maybe you could tell us what is that and who is this for?
So I think this might suit most of the audience today. So these days, I think a lot of Singaporeans do not only want to ensure that they have enough for their retirement, they also wish to leave behind a legacy for their loved ones while also ensuring that they have their retirement funds preserved. So we need to recognize this. When we reach the top of the triangle, without any real strategy in place, we might run into the risk of depleting our retirement nest by drawing down from our resources months by months. So with the right instruments and right applications, would you prefer to have a regular cash payout for your retirement and still seeing these funds still being largely intact at the age of 70s, 80s? Well, knowing this, that this golden nest is well protected and preserved for the next generations. If the answer is yes, I think generally because we have families and we actually wish to pass on our legacy over to them. A good example for wealth preservation will be endowment policies that is designed for wealth preservation. For example, in fact, we can actually, with a single premium, we can provide us with a monthly lifetime cash payout, starting from the third year onwards all the way until age 120. So through such an instruments, we get to actually have the chance to leave a legacy for our loved ones with a secondary life insurance and even get protected against things like death or even terminal illnesses.
Now, I just want to go to, we're getting a slew of questions from our audience, and perhaps this question could be addressed to Tim. Yeah, it's from Chai Singhua, and she says, for those with health problems, the bulk of our money go to medical treatments and insurance premiums due to loading. So what's the best strategy for retirement for these types?
Yong Chuan, should you be the one answering?
Yeah, I'm okay with that. I think yes. I think
loading, because of its loading, right?
No, it's okay. I think healthcare and long-term care is a key concerns for many retirees. And then we have the conception that insurance tends to be more expensive or more costly when we age. So basically, sometimes we have to recognize this, that when we age, we do need to constantly review and adjust our lifestyle and even for our insurance needs. So we need not try too hard to actually reach the highest possible coverage. Instead, we can look into the basic coverage at a lower premium, for example, or if there's alternative, we just look at the instruments available in the market. In insurance term, I think being well protected actually help us to actually hedge against illnesses, accident, or even long-term care example. So basically, I just want to actually re-emphasize, we need to transfer this financial risk to the insurer. So basically, right, do it as early as possible. Otherwise, when we get old, I think certain things like exclusion will come into the picture, and this is something that we cannot avoid.
Now, we're also getting a lot of questions about CPF, and maybe Jinsen, you could weigh in here. Basically, if you could comment on CPF as a building block towards retirement, and what else would be good as part of the strategy?
We have seen surveys on how retirement families have been spending in their retirement years, and this is through the household expenditure survey that's conducted every 5 years, for example. CPF alone isn't enough. You need to have a whole range of other building blocks, as you suggest, to actually provide into your retirement income. I think the survey right now, if I can just pull it up, yeah, it's really CPF is just less than 1/5, provides for less than 1/5 of the overall household expenditure for retirement households. The reality is that a lot of it comes from your investments and your passive income, as well as rent, which is 12%, and family transfers, which is the income that your younger generation passes to you. The reality is that all these are going to change very heavily, because this only affects the average retiree today. Each person's circumstances are really very different, and it doesn't include personal income of retirees as well if you're working till old age. So how will that change, and what sort of a reality it will be in future, whether you have family members to provide the shortfall that you need for your daily retirement life. It's really depending on each person's circumstances. But at the end of the day, it's important to really come back to diversifying the various sources of income that you have to come up with a holistic retirement plan. And the old adage is true. You speak to a financial advisor on what you actually have right now and what you want to achieve in future, and set that goal so that you can slowly make baby steps towards it. And that's especially true if you are a younger person.
I think we've got time for just one last question, which I think Tim should be able to answer for this one, because earlier you talked about being as part of the sandwich generation, and somebody has asked, how do we practically apply Me First in financial planning, or in your instance?
So, like for example, I think I narrate about what my parents did when they were in their younger days. So right now, what I'm doing for myself is, like I run a business, right? So with entrepreneurship, financial stability is not something that I can take for granted, because with businesses, you can do well one year and you can not do so well the next year. So what I do to counter that risk is I actually try to make it a point to always do something for my retirement every year, right? So on some years, it can be as simple as I just put a little bit more money into my CPF special account, and I've done that in the past. For some years, I put aside a little bit of money in my SRS. And then, of course, you got to invest your SRS in order to generate returns. And, for some years, just to invest, set aside a little bit of your money just to invest a little bit more. So I always make it a point, because, there is, when you're running a business, you have parents, you have kids, there's always so much cost consideration coming your way, and you have to do something for yourself and also your spouse, right? So my wife does it as well for herself. And I think that's something we try to do, because to me, I think every little step matters. Nobody can tell you whether retrenchment. There were a lot of retrenchment last year, right? And even if you run a business that's stable, things may not go well in the next few years. So these are things we cannot take for granted. And I think for our retirement, we have to ensure that we do a little bit every year. The other thing I also want to stress is that I think a good retirement plan can't be good unless you are well covered, well insured, because investments is like your upside, right? You want to get as much return from your investments, but insurance covers your downside. So I think any good retirement plan needs to take into consideration both, your investments, your CPF savings, as well as your medical insurance. So this could be government mandated coverage like your MediShield Life, your CareShield Life, or it also should be other insurance coverage like your early CI, your life insurance policy, your disability income. And these are things we have to take care of it on our own, because if we don't, then nobody will help us with it.
We certainly have still so much to cover and so much to talk about, but unfortunately we've come to the end of the hour. So I'd just like to thank Junsen, Tim and Yong Chuan for sharing your personal views and tips with everyone, all of us, myself included, this evening. But just before I let you go, perhaps you can share some parting words with our audience. Tim, you want to go first?
Okay, I think we talked a lot about financial stability today, and it might feel like, hey, I have to keep saving money when I'm young and then I can't enjoy my life. I don't think that's true. I think financial stability doesn't come at the expense of what I call a YOLO lifestyle, right? In fact, among, I think most of us here in the panel, we are in our 30s right now, and what I was am observing is that the people who are enjoying their life better tends to be the ones that have financial stability. Right, so what they do is that they save at an early age, they invest when they're young, and now that they are in their mid-30s, their 40s, they are able to enjoy life the way they want it to be because they already have financial stability. So I think for those of you who are watching this and you might be young today, don't think you have to sacrifice all the lifestyle you want in order to get financial stability. It's only when you have financial stability, then you can enjoy your life better.
Junsen?
Right, I think my parting words would be a reiteration of what others have said in this session, which is really insightful. A comfortable retirement at the end of the day means living with purpose and dignity. And in order to get there, we need to start thinking about our long-term financial goal. That means you have to ensure enough investment instruments and set up alternative income streams to make up a holistic retirement plan, as what Yong Chuan and the others were talking about earlier. And this diversification is key because it just allows you to have such a resilient retirement plan, something that's especially important during this period when you might be faced with an untold crisis, and having insurance to bolster that kind of planning would really, really help. And diversification helps to maximize the sort of risk reward that we get from our investments. Because with so many competing needs for more and more and more, we also need to have this diverse spectrum to guard against the rate of inflation.
And last but not least, Yong Chuan.
Thank you, Otelli. And once again, I think it's a joy to be here with Junsen and Timothy. So to end today's webinar, right, I just want to bring back everyone to the concept of me first. So don't ever feel guilty about saying no when we cannot fulfill everyone's desire. I think it's only natural that we feel a little bit disappointed when we cannot fulfill all the desire that people around us want, okay? Because it gives us a greater freedom to pursue our dreams and support our own family members when the need arises. So I do hope that the audience today can understand that by saying no from time to time, it can actually help to be beneficial for the whole family in the long run. What it all takes is just adjustment of your mindset and perspective towards life. Thank you.
Thank you so much, gentlemen. I've certainly learned plenty tonight. Thanks again to our gentlemen, and thank you to all of you for attending this evening's webinar. Just before we go, I just want to highlight that the content presented in this webinar is for informational purposes and should not solely be relied upon as financial advice. But for customized advice to suit your specific needs, we recommend you to consult an income advisor. So for more information, you can also visit income.com.sg/mefirst. Remember, the best plan for your retirement is to start with me first. Thank you and good night.